Okay. Good morning, everybody. I just realized I'm muted. I was muted while I was saying good morning. So good morning, everybody. Happy to see everybody filing in. It's Tuesday, December 14th. As always, we have a ton to talk about today on this weekly webinar, and I'm glad to see everybody. So One, I appreciate you taking the time to join us. I really enjoy these educational webinars, and I hope you do too. As you know, at the end of the webinar, if you're watching it live, at the end of the webinar, my calendar will pop up, and you can schedule time with me if you'd like to. I'll tell you a secret, there's no time left in December. We'll talk about that again in a second, but I'm completely booked up for the rest of the time we have in December. If, of course, you're a client and you need something, reach out directly, and we'll make time to see you for sure. If you're watching a recording of this video, in the comment section or down below in the section, you'll see a link that you can use to schedule an appointment with me, and that'll be a Zoom appointment. So wherever you happen to be, we can spend time together. If you're here, if you're watching this on via recording and you're only here for the financial planning update, which today is housing and retirement, how to fund it, how to choose what you want to do, and just having in part of that discussion, then you're going to want to fast forward to about the 30-minute mark. We break down this webinar. We have slot updates for the first 15 minutes or so. These times are a little loose. For about the first 15 minutes is the slot updates. And that's all about IRA distribution updates. If you don't know who Ed Slott is, go to, you can Google Ed Slott. Market updates and analyst reports are the second 15 minutes. And then the final 15 minutes, so about 30 minutes in, the final 15 minutes or so, as you know, if you're on these webinars often, is the financial planning topic, which again is today is housing and retirement. So I want to remind everybody who's on the video live that this is, you are muted. There is a Q&A section at the bottom of the screen. Your chat is disabled. And of course, as you heard when you logged in, this webinar is being recorded. So first, just if everyone can, or someone can raise their hand, make sure that you can hear me and see me okay. Thank you, everybody. We got a good group today. All right, we have just one more webinar before the end of the year. So our next week, which will be the 21st, will be the last webinar for the week. So I'm going to miss you all during the holiday break, but I hope everybody enjoys their time off. Our offices are closed from noon on December 23rd. We have our holiday lunch, and until January 3rd. So now, if you're a client, Jessica, our office manager, will be checking in periodically. She does that typically during this break. And if you need something, and you can email us. And then, of course, if you really need something, you can. Everybody has my cell phone number. So that's going to be the Christmas break, the holiday break, whatever we want to call it. And we do have lots coming up already for 2022. So we have a David McKnight webinar coming up. I'm scheduling it somewhere between the end of January, early February. And then I'm working to have David McKnight live here in the Bucks County area. So that's very exciting. All right, let's talk about what's going on right now. The big headline, as you probably know already, was the Consumer Price Index report that came out at the end of the week last week. Just trying to get to that section. Sorry about that. The Consumer Price Index that came out at the end of the week last week. So the year over year, so this is as of the end of November, year over year inflation was 6.1 or 6.8%. That's obviously very high, well over a traditional inflation. We've been seeing very low inflation for the past couple of decades, really, certainly the past decade, that we've seen low single digits. Now, 6.8% is unsustainable for your average American. And I'm going to share the report that came out as Consumer Price Index when we get to the market section. But I just want you to really be aware of and think about what that means. We're already seeing it. All of us are seeing it in fuel prices, food prices, very, very directly. there's discussion about, is this, transitory, as the Fed chair is saying, and we'll talk a bit about that in our analyst report. But just this morning, there was a producer price index. So the Bureau of Labor Statistics also releases a producer price index, and that's up 9.6%. So that's loosely really the cost of goods and producing what we purchase. So that can be a leading indicator, which means this is what we're going to see in the future, and that's pretty frightening, 9.6% year over year. So let me let you stew on that for a minute, and we'll come back to it. And let's go over the slot updates. So the first thing we have is from the slot mailbag, and this is Sarah Brenner. You all probably remember Sarah. And she'll be another guest at some point probably in the first quarter of the year. So I should put her on the list so I remind you folks. But the question that came in and Sarah's answering is, if the owner of an inherited IRA was required to take RMDs from the IRA prior to his death, can a beneficiary who is younger than 70 and a half request QCDs from the inherited IRA? So a lot of initials there. So RMD, required minimum distribution. Currently, once you reach 72 years old, you're required to start taking distributions from your IRA. That's determined by a table that we have. If you do not take those distributions that you're required to take, you're penalized 50% of what you should have taken. So it's an absolute must. And then she asked about QCDs. So we talked about QCDs a week or two ago. QCDs are qualified charitable distributions, and that gives an IRA owner the chance to send a direct payment to an insurance company without paying tax on that. So they're up to $100,000 per individual per year. So that is really exciting. So they're asking, now I've inherited this IRA. Can a beneficiary who is younger, so the person who passed was required to take required minimum distribution. So they're at least over 70 and a half if they're following the old rules, or over 72 under the Secure Act rules, but they're required to take RMDs. Now, the person who inherits it is younger, and they wanted to know, well, can I send that money right to charity so now I don't have to take it and pay tax? They noted we understand the beneficiary is required to take the required minimum distributions based on the deceased owner's life expectancy, because the new owner inherited the IRA in 2019. Okay, so that's more information. So this was before the new rules, so they have to take required minimum distributions. The answer from Sarah is, this is an interesting question, Bruce. A beneficiary of an inherited IRA can do a QCD, qualified charitable distribution, and use the QCD to satisfy the RMD for the year. However, to be eligible to do the QCD, the beneficiary must be 70 and a half or older. Now, this is where it always gets confusing. The new RMD rules are 72. The QCD rules are 70 and a half. But if you inherit an IRA on the prior rules, you must take required minimum distributions along the way, whether you're 70 and a half or not, right? If you're younger, you still have to take them under the old rules. Currently now, if you inherit an IRA, you have 10 years to distribute those funds. But the person who inherits the IRA must be 70 and a half to be able to do the QCD. So it doesn't follow the person who passed. It's your age, the person who inherited the IRA. So that is an interesting question. The next question. Upon death of a spouse, can the IRA of the deceased spouse be rolled over to an existing IRA of the beneficiary spouse, or must it be transferred to a new IRA of the spouse's beneficiary? So that's a little confusing the way that's worded. But let's just say that the question is, your spouse has passed away, they have an IRA. Can it be rolled over to an existing IRA that the spouse already has, or must a new one be created to track that inherited IRA, right? The answer is from Sarah is to Sid, the person who wrote this is Sid. A spousal rollover can be done to an existing IRA in the spouse's beneficiary's own name, or a new IRA can be set up. Either way will work. Well, that's good. And that's a good answer. There's a lot of flexibility there. So adding in there, they can also do an inherited IRA if they want to, or if it's beneficial. So a spouse has a lot of flexibility. Could it make sense to keep that IRA as a spousal rollover and not combine it with their own IRA? Well, sure, there are some reasons that could make sense. So this all goes to proper planning. And what I always say is when someone passes, first do nothing. A lot of organizations are very, very fast to say, we want you to transfer that money. We want you to transfer that money. We want you to roll it over as quickly as possible. You've got a lot of time to take care of that. So be thoughtful in your approach, do your homework, talk to a qualified, I believe, certified financial planner, and get these answers and look at all the pros and cons of each option there. So really good questions. All right, the next thing that came out yesterday from the Slott Group was what's the status of all of these congressional retirement proposals? And this is really timely. I was just thinking about that over the weekend. I was thinking, really what's myself, I read these things all the time, but what's going on out there? So we know that during 2021, Congress has taken up a number of different retirement proposals. It's been difficult to keep track of them. Here's an update, they're right, of how things stand at the moment. Of course, new developments could occur at any time. So we have the Build Back Better Act. So that was passed on November 19th from the House of Representatives by a 220 to 213 margin. This is a $1.7 trillion bill that includes a number of changes to retirement account rules. Those changes are similar to, but not exactly the same as the changes proposed in an earlier House Ways and Means Committee bill. So that's still potentially out there. It's unclear whether the Senate will pass the House version of the BBB, right, the Build Back Better plan, a different version that may or may not include the retirement provisions or none at all. In any case, here are the changes of what were passed in the House of Representatives in November. Conversions of after-tax dollars. So this is what's called the backdoor Roth IRA or mega backdoor Roth IRA. So when people can't make Roth IRA contributions, they contribute to a non-deductible IRA and immediately convert those funds to an IRA. We've talked about that before. There are a lot of rules around that, but this will be eliminated by January 1st, 2022. That's what the law called for, the bill called for all individuals, regardless of income. So you just could not do it anymore. Conversions of pre-tax dollars. Roth conversions of pre-tax IRA and company plan funds would be barred for high-income individuals. So right now, anybody can do a Roth conversion from an IRA, regardless of your income. There are limitations on contributions, income limitations on contributions. You can find those limitations on our website, attleborowealth.com. Go to the slot corner, and there are charts there where you can find them. But right now, under the current law, there are no income limitations on conversion. So if you make $1 million a year or $100,000 a year, you can convert as little or as much as you'd like in a Roth, from a traditional IRA to a Roth IRA. This bill would shut that down. So single taxpayers with modified adjusted gross income over $400,000 would not be able to do Roth conversions, and married taxpayers filing jointly with a modified adjusted gross income over $450,000 would no longer be able to do Roth conversions. Now, this part of the law, unlike the elimination of the backdoor Roth IRA contribution, is not proposed to be effective until 2032. So we have 10 years still. That gives you 10 years still to make these conversions. That 10 years is going to go fast, I'll tell you, because if this goes through. And I'm not going to comment on my thoughts about that. I was just about to, but I'm not going to. But that window will close quickly because we've already had windows close quickly behind us. As you know, it's been now 10 years that I've been on this tax efficient Roth conversion journey, and I've seen several gates close behind us already. The next is contribution and RMD limits for mega IRAs. So what is a mega IRA? A retirement account that exceeds a $10 million balance. They'd be subject to two new limits. First, you would not be allowed to make additional IRA or Roth IRA contributions. So if your IRA is more than $10 million, you can't make any more contributions. Second, a required minimum distribution would be required regardless of age. The limits wouldn't apply until 2029. But the Ways and Means Committee provision would have been effective in 2022. So you could still see some difference in there. That's a big one. What essentially means is, if say you have $13 million in your IRA or Roth traditional IRA or Roth IRA, you would have to take a required minimum distribution of 1/2 of the value that's over $10 million, and that's each and every year. So that's really a lot of money that's coming out of those tax sheltered vehicles. New reporting requirements. There's a proposed new annual requirement for employer defined contribution plans to report information to the IRS on accounts balances of $2.5 million or more. The new reporting requirement was also delayed until 2029. So again, they're really pushing this. They're saying this is what we're going to do, but we're not going to do it for several years. Statute of limitation for IRA noncompliance. This extends the statute of limitation from 3 to 6 years for the IRS to go after misreporting of IRA valuations and prohibited transactions. That would be effective January 1st, 2022. Two controversial provisions of the Ways and Means Committee bill were dropped in the Build Back Better plan. The first would have prohibited IRA investments limited to accredited investors. So there are some rules behind accredited investors, and you have to have a certain amount of net worth and a certain sophistication with investments. The second would have tightened the prohibited transaction self-dealing rules. And they go on to say, meanwhile, several different retirement bills, some with common elements, have been making their way through Congress. The goal of these bills is to further improve retirement saving opportunities. Those bills include Securing a Strong Retirement Act of 2021, commonly known as Secure Act 2.0. That's what the House Ways and Means Committee passed back in May. Among those provisions of Secure Act 2.0 is a delay in the RMD age and an increase in IRA and catch-up plan contributions. That would be nice for our folks if we could delay RMDs. The discussion was delaying it until 75 years old, and then it would increase from there. Although Secure 2.0 and other bills related have enjoyed bipartisan support, it is unlikely any of these bills will be passed until at least early 2022. And remember, these are only these are proposals. The Build Back Better plan has been passed by the House, as I said, but the others are proposals. Okay, that's a lot. All right, so moving on. Let me just see if there's any questions. No questions. Good. Moving on to the market. So we talked about the CPI. And why is this important? Consumer Price Index and inflation, 6.8%. Why is this important? Well, there's a couple of things. First of all, you need more money when things cost more. Housing costs, we're going to talk about housing today. Everybody knows that housing is really out of control, in my opinion. It's I can't believe what I see houses in our area selling for. We've been here now where I live 13 years, and I just am amazed at how the values have increased. So that's good if you own your home. It's tough if you're a younger person looking to buy a home, and it's also tough when you're transitioning, because you might sell your home for a lot more money than you paid for it. But you have to live somewhere, right? So let's take a look. I'm going to share the Consumer Price Index report that I see with you, and you can sign up for these yourself. They're just emails from the Bureau of Labor Statistics. So if you're so inclined, you can sign up for it. Now, let me make sure. I just shared my screen, but it looks like, I'm not sure. Are you seeing something here that says, I'll bring it down, U.S. Bureau of Labor Statistics? Is that what you're seeing on your screen? Raise your hand. Okay, excellent. Thank you. Usually I get a green a frame around what I'm sharing, but in this case, I don't have that. All right, so let's take a look. This is really simple. In a couple of days, I'll get a report that gives a closer breakdown of what inflation is here locally, all the regions throughout the country, but I pay attention to basically the Philadelphia, New York, New Jersey area. But we have clients all over the country, so it's important to know what's going on here. So all items you see here, all items. Let's highlight this. 6.8% year over year. So unadjusted 12 months ended November 2021. So that's looking back from last year. Inflation has increased generally 6.8%. You see some higher numbers here. Energy 33.3%. Energy commodities, 57.5, gasoline, 58.1, fuel oil, that's what fuels my house, unfortunately, 59.3. General energy services, 10.7, and you see that continue. Piped gas, 25.1. There has been some modest increases. Medical care is relatively small. Shelter, 3.8. Transportation, anyway. And then you'll see this, all items less food and energy is 4.9. Sometimes you'll hear that, the CPI less food and energy is 4.9, and some folks will use that as a spin. Well, people are saying inflation is 6.8%, but it's really this if you adjust for it. Listen, folks, this is where a lot of us live, right? Food and energy here. And then there's other CPI scales out there that we should also be paying attention to, but these are really high concerning numbers. So we need to pay attention to it. We need to plan for increased inflation for a period of time. So let me stop sharing. I talked about the Fed chair and some other analysts are saying, well, this is the hot term right now is transitory, right? So this is a short-term issue, this higher inflation, and that may be. Costs were very, very low in 2020 because of COVID. Gas was very cheap, other things were very cheap, and now we have people trying to buy things they can't. It's pushing up the cost of many goods. I stopped in a local store to do some Christmas shopping yesterday, and the things I wanted they didn't have, nothing. So the things on my list I couldn't get. Now they usually have them, but they can't get them. So I've used restaurants and bars and things like that as just one little look at our experience. You've all experienced this, I'm sure, of how things are being affected for us out there with inflation and supply chain issues, which is tied to inflation. There's we expect the Fed tomorrow is going to discuss their thoughts on interest rates and inflation going forward, and that's obviously going to have a move on the market. We'll have to see what's going to happen. I'm looking at my note from the beginning of the year. It says plan for a rocky 2021. Most of the rockiness seems to be in the last quarter here. It's been a difficult quarter so far, for sure. Last week, we had a good week. The Dow Jones Industrial Average was up 4%, 4.02%. The NASDAQ was up 3.61%, and the S&P 500 was up 3.82. The global index was up 2.74. So that was a good week. Now, so far this week, it's not so good. Let's see where we are right now today when the market's open just about an hour ago. Oh, market's up a little bit, 36. It was down 300 and some points yesterday, the Dow Jones Industrial Average. It's up a little bit today. That surprises me. We'll have to see what happens. The NASDAQ's down 164 points and the S&P's down 26. So, the Dow Jones is up a little bit. The S&P's down a little bit. The NASDAQ is down more. So we'll have to see where the day and the week ends. But, it's important to be concerned about things like inflation. You shouldn't brush them off because you're going to have to pay for these goods whether you want them or not. Basic staples, food and fuel, you're just going to have to pay for. Can you do less vacations, less traveling? Sure, but you still have to get around. You still have to eat. All right. BlackRock, on to analyst reports here. BlackRock took a surprising position. They seem to be, from what I'm reading, a little less bullish, so they're a little less optimistic about stocks going forward in 2022. And they write this, the 2022 outlook. We see 2022 heralding a new market regime by delivering global stock gains and bond losses for a second year in a row, a first in about half a century. So they're saying that they think the stock markets are going to be up in 2022. Bonds will continue to struggle, right? They're saying bond losses. Bonds are very, very difficult environment right now, because it's all balanced around interest rates, and interest rates are pretty tough to negotiate. But they said, here's the synopsis. We are entering into a new market regime. We just said we expect another year of positive global stocks returns coupled with a down year for bonds. Central banks are set to raise rates but remain more tolerant of inflation as the restart rolls on. We see inflation settling above pre-COVID trends, so they're optimistic that eventually it'll settle in normal trend lines. Before COVID, we're going to be living with inflation, they said. We're always living with inflation. But the question is, are we maintaining 6.8%, 4%? 4% is pretty difficult to overcome too. So we need that good average of 2.5%, 3%. We favor equities over income as a result, but have dialed back our risk taking given the wide range of potential outcomes in 2022. So that's a shift for BlackRock. That means they still think that stocks are going to do better than bonds, but they've dialed back how much they're going to overweight into stocks. So that was interesting for me to read. This Robert D. Lucia had he's from Prudential. He had some really interesting thoughts on inflation that I'll share with you. He talks again about this transitory. Many economists, along with the Federal Reserve, have described the spike in inflation as transitory, which could fade as supply conditions improve. Of course, that's going to help. Supply conditions are going to help. It really depends on workforce issues. And everything that's involved around the general cost. And then there's also the mindset. Once people get comfortable paying close to $4 in a gallon in gas, if you're here on the East Coast, it's worse on the West Coast and other parts of the country and other parts of the world. There becomes like just a comfort level with certain prices of things. So, that might be 4.5% higher than what they were a year ago, and that's still very, very difficult to overcome if that trend continues. There has been considerable volatility in government data on inflation over the past year, he writes. Following a moderate 2.5 rate of inflation in the first quarter of this year, core consumer inflation spiked in the second quarter to an annual rate of 2.5. Since July, inflation has moderated to an annual 4.5%. Again, we see year over year at 6.8 right now. I'm sure this report was written before that. He goes on the right. My forecast has not changed and involves three phases of swings in the inflation rate. The first phase, a spike in inflation because of transitory. There's that word again, right? That's really the mantra out there, is transitory. Surge in demand relative to delays restoring normal production is nearing an end. So he's saying this is coming to an end now. We're going to start seeing normal production. The second phase could persist for the first 6 to 9 months of 2022 and involves a moderation of inflation pressures as supply chain disruptions are resolved. So for the first 6 or 9 months of 2022, he expects the inflation to settle around 4.5%. And then he says the third phase of inflation could begin later next year and persist around throughout 2023 to 2024 as the economy reaches full employment and is stressed to meet the persistent strength in demand. During this phase, the consumer inflation rate could rise to 3.5 in 2023 and approach 5% in 2024. That's interesting. 3.5, still higher than I'd like to see. 5, very challenging. And he's saying that's even after we settle into full employment and normal supply chain in 2023 and 2024. So, and then Riverfront, I'll move on to Riverfront. I got to tell you, there wasn't much there, but just to wrap up their year, kind of, the market's rise, this is what they wrote. The market's rise has been justified by strong fundamentals in our view. We expect continued growth in earnings and remain bullish on stocks. Again, they think that stocks are going to outperform bonds into next year. We believe investors should prepare themselves for the inevitable corrections that will come. All right, so they didn't say much there. They're one of my favorite commentators, right, of market activities, but they really didn't say much there. They must have had a busy week and didn't have time to write much. But what you're hearing, what I'm seeing from all over different analysts are this concern over inflation. Some people are playing it off more. And, I was listening to a fellow this morning that doesn't really have concerns about it. But I would say the majority of folks, and maybe this is just what I'm drawn to, has this concern about inflation. So how do you handle all these things? Going back, you hear me talk about this all the time. You need those three fundamentals: asset allocation, principal protection, and account segmentation. We need to fund these things in your life. These things need to change all the time because our financial planning tools that everyone uses makes inflation assumptions right around 2.3%. Well, suddenly, if things are costing, general inflation is 6.8%, I think that would be inappropriate to assume going forward for the next 20 years, 6.8%. But what if that 2.3% or 2.4% becomes an average of 3.5%? Do you think that 1% difference can make a change? You're darn right it can. So you've got to stress test these things. Make sure that you're still set up correctly and make changes as you need to. I'm moving things around in my mind and what I'm trying to show you here. But my point is, when you develop your asset allocation, you have an amount that's available, allocated to principal protection, and then the account segmentation. That account segmentation becomes key, because if you need $10,000 more a year because of the cost of things, you need to fund that. So you're going to need to move your funds from later year funds to current year funds. And you're desperately going to need those later year funds taking more risk, getting more return, so that they'll help you fund what you need now and in the short term. I hope that all makes sense. If it doesn't make sense, I apologize. It is very complex, but I'm happy to review your situation with you individually and talk more about that. All right, so let me just see if there's any questions. Gerard must be on vacation today because I'm not seeing any questions. So listen, let me just wrap that up before I go into financial planning. Again, those three pillars: asset allocation, principal protection, account segmentation. If you add in there guaranteed income for life, that's great too. But you need that flexibility, you need that constant vigilance, and you need to stress test these things, because you don't want to just end up there. Oh my goodness, I didn't see that coming. Why didn't we plan for it? Okay, so I'm gonna now share my screen with you, and we're gonna go into the whiteboard, and we're gonna talk about housing with financial planning and retirement. All right. So you should see my whiteboard in front of you. Just raise your hand if you see my whiteboard, and it should say financial planning topic, housing and retirement. Great, thank you, everybody. All right, so I'm gonna first launch a poll here. So let me find my polls. And the first poll is going to say plan for housing and retirement. And the question is, do you have a plan for housing and retirement? And the first answer, this is multiple choice: yes, I have it all figured out. The second answer is no, too much to consider. And third, I'll see how the wind blows. That's the first answer I got. So I'll see how the wind blows. All right. This is very interesting. It's almost dead even as we go. That's really interesting to watch. I don't know if you folks can see this or not, but can you see the poll as it's being answered? Raise your hand. No. All right, so here's where we are. Okay, you can see it. Okay. We've got about, it's pretty well split. 33% said, yes, I have it all figured out. 25% says no, too much to consider. And then 42% says, I'll see how the wind blows. Really great. I guess you're seeing it on my screen, aren't you? All right, let's end the poll. They're really, really interesting to see. Thank you. All right, so let's talk about some of the things. Now, in this first section here we're talking about, and you're gonna see me look down. I know I explain this every time, but I don't want somebody who's joining us for the first time to say, what's he doing? This is a pad that I draw on, so I want to look down so the writing isn't crazy. But there are some common things here. So the first really common item I hear from folks is, I want to downsize, right? I've got this big house, I've got this yard to maintain. This was great when the kids were here, or for whatever need I had. If you don't have kids, but I want less to take care of. There's some questions, right? Well, where are you going to go? Are you going to stay in the area? Are you going to go someplace else? A lot of people talk about Florida, Arizona, the Carolinas. So it's and then it's also, well, where are the kids going to end up, right? I want to have grandkids, and I want to be close to the grandkids. And believe it or not, I had this discussion with my 15-year-old daughter yesterday as I was driving her back from dance last night. I told her, I'm probably not going to buy a house right next to you, but where if you land far away, I want to be close. So, I don't want to crowd her. But where is important? Of course, how much? How much do you want to spend? How much can you spend for the housing? And how? We're going to talk about how. How do you fund this, right? Now, that is an important topic. And this is where a lot of the questions and some of the creativity can come from. This is where it can get really exciting. There are things that people just may not be considering. How about staying, right? Staying in your house. Well, you can renovate, right? You can renovate. I was talking to a couple of clients and they said, well, maybe we'll just stay here. But the problem is we can't do the steps anymore. Very soon, we're not going to be able to do the steps. Well, listen, when we moved my mother up from Florida, my sister and brother-in-law renovated their garage and made it an in-law suite. That was a really great solution for my mother and stepfather for a long time. And so that may work for you. You can put a bedroom on the first floor. You can renovate a garage, maybe have your kids move in. That may work for you. It may not work for you, but you can stay and renovate. How would you fund this? That's another question we're going to get into. How do you fund renovations, staying in your home? Because the staying problem might be you might have a current mortgage and you might say, one of the things that I want to do is eliminate this mortgage. Well, you can eliminate it by paying it off, or you can use other funding sources. So we're going to talk a bit about that. And then, of course, when we're talking about selling and buying, again, where, how much, and how are very, very important topics. So the where I can't help you with, right? These are emotional topics. What I do recommend to folks often is, I'm thinking of one couple in particular. We've been talking a lot about their housing situation. And that's actually what spurred the content of this webinar today. We've been talking about their housing situation quite a bit, and they have ideas about moving to Florida, but they're just not sure. Some people move to Florida with the idea that they're going to love it there and don't love it, right? It's hot all year round. It's hotter in the summer, obviously, and some folks don't like that. So what I suggested to them was, well, maybe rent for a little while. Maybe you rent down there for a year or two to see how it is, see how you like it. You can rent in different parts of Florida. As long as the funding is there and the planning is there, then you can have some flexibility. Now, I could see, I'm just thinking of two examples that really eased the minds of folks who I was talking to. And that's a little bit of, psychology for sure, but it doesn't all have to be black and white. It doesn't have to be sell your house you're in now where you've lived for the past 30 years and move to buy a new house in Florida, in the Carolinas, in Arizona, in Alaska, wherever you want to go. You can explore and you can live places for shorter periods of time. You can rent a place for a year in Florida. You can rent a place for a year in Oregon. If you love Pinot Noirs and you want to live in Oregon wine country for a year, that'd be kind of fun, wouldn't it? So there's a lot of things you can do, and once you figure out how to do it or what you want to do, then we can figure out how to fund it, the best ways to fund it. So that exploration process is really interesting and fun. And then the creative process around funding can be really exciting. And I do encourage anybody I work with, clients I work with, to first of all, I love it when they move to warmer climates because I get to visit them when it's cold up here. Oregon would be really great. I love Pinot Noir. So if anybody wants to rent or buy a place in Oregon, I'm happy to come out and see them once or twice a year. So there's a lot of exciting things that you can do when you're considering the sell or buy. So now, when you figure out what you want to do and generally where you want to go, the next question is, how do you fund this, right? So let me launch another poll. So I'm going to close this poll. And then this one's a little more in depth, so it's going to take some time. So the first question here is, and can everybody see the second poll? Raise your hand. Great. How will you fund your housing plan in retirement? Take out a traditional mortgage is the first question. Sell some or all of my investments is the second question. Oh my goodness, this is a single choice. All right, hold on. I'm going to edit this on the fly here. Okay, now here we go. Now you should have the opportunity to answer multiple choice questions. So how will you fund your housing plan and retirement? Take out a traditional mortgage. Sell some, so that's the first answer. Sell some or all of my investments, your taxable investments. Take distributions from my IRAs is another answer. Leverage my taxable investments for tax-free funding of my home purchase. Tax-free withdrawals for my cash value life insurance or retirement or life insurance retirement plan, or use non-traditional mortgage options in home equity line of credit, home equity loan, or reverse mortgage. Can everybody see that? I'm only seeing a few answers, and all of them say take out a traditional mortgage. Okay, here we go. Sell some or all of my investments. Use traditional mortgage options. Okay, that's interesting. Good. Use non-traditional mortgage options. Excuse me. Take tax-free withdrawals from my cash value life insurance. Somebody answered that. That's great. All right, really interesting. Most non-traditional mortgage and traditional mortgage are kind of neck and neck. And then we've got a couple other sampled in there. So that's really exciting. Many of you folks are thinking outside the box, and that's important. So let's talk about these other funding options. So first of all, we know that the first thing you have to consider, let's talk about options. So here, let's talk about the house, right? Because we talked about the whys and the wheres. So let's talk about the house. And I'm going to end the poll here. Yeah, pretty well, just to give you the results. So 47% said take out a traditional mortgage, and 35% says use non-traditional mortgages, home equity line of credit, home equity loan, reverse mortgage. And I plan on having Don Graves on in 2022. Don Graves is the reverse mortgage specialist that I use when I refer people for reverse mortgages. They've become very, very interesting and a really interesting tool to help fund things like this. I'll talk about it a little bit. But so we'll have another special webinar with Don sometime in 2022. And then the other ones are pretty evenly split. So I'm going to end that poll. Thank you for joining in. All right, so here are the hows. Well, we have traditional, right? So sell, buy. Well, that's really simple. You sell the home you're in and you buy a new one. That's the traditional way. Now, that's fine, and you can fund it in all the various ways that we just talked about. You can simply take the proceeds of the home you're in and buy a new home, or you can take some of those proceeds and include some of your investments that you liquidate and buy your new home, and then you don't have a mortgage. You can take the proceeds of your home and also have a mortgage, right? If it doesn't cover the whole thing. When you sell, we know that you have up to $250,000 for a single filer and $500,000 for married filing jointly of capital gains in your home that are not taxable. So if your home value has grown more, very simply, when you can have additional cost basis in your home if you've done renovations and things like that. But very simply, if your home has grown from $500,000 to $1 million, then you're married, you could have zero capital gains. If it's grown to $1.5 million, you could have $5 million or $500,000 in capital gains if you don't have other costs of improvements, etc. So you got to pay attention to that. So you could have to pay tax on gains that are in your home. So if that's the case, then it makes sense to get creative. And in other cases, it might make sense to get creative. So this is a very traditional approach. And then there's different funding options in there. You could sell your existing and rent the new, right? That's what I talked about. You sell your house up here or wherever you are now, and then you rent for a little while. So wherever you want to be, maybe you rent forever. Maybe you only rent for a year or two until you say, this is the place that I want to stay. I see a question. I'll get to you in a minute. Let me just make sure you're not telling me something I need to pay attention to. All right. So you can sell, rent your new. You can rent your existing, and you can buy or rent new. So this is something I was talking to a client about, and they said to me, we didn't consider that. So I want you to think about that for a minute. Okay. Thanks, Rhonda. So Rhonda can now see. So they have, they have a home locally here, relatively locally here, and they could probably get about $3,000 to $4,000 a month for their home. Now that's just a traditional renter. There are other, if you really want to get creative, locally here in Newtown Borough, there's a woman who does Airbnb. She rents out her house using Airbnb. So she stays in it sometimes, but she rents it a lot of time. She makes over $8,000 a month typically on the rental of that home. And boy, listen, I don't care who you are. I think $8,000 a month is a lot, but they know that in their area, they could rent their home for about $3,000 to $4,000 a month. Now they may not want to be there to take care of it, be available, but you can always find, you can pay a management company to help. And there's some benefits to that, right? Because if your home right now is worth $600,000, let's just say, and you rent it out for the next 10 years, well, it could be worth $800,000 during that time. It could stay the same, whatever the situation is. But you could potentially have an opportunity for growth while you're still collecting income and using that income to either buy or rent your new home. Right? Because that $3,000 to $4,000 a month, or whatever that might be for your area, it might be $2,000 to $3,000 a month, would go a long way to help pay the mortgage on the new home, or to pay the rent on the new home. So think about that as well. Now, it doesn't mean you have to be in the business of being a landlord. Again, you would technically be a landlord. There are some tax advantages potentially to that. So you've got to pay attention to that. But you can find a management company to help you with that. They take a portion of the rent. It's not cheap, but it's certainly, you have to balance it just like anything else. There can be tax advantages also to having a rental property. And you want to discuss that with your CPA, your CFP, your team, right? This also your attorney, if you set this up. This is another area where you need your team to help put this together for you. But that can be exciting. I think about, I had this client move to Florida some time ago, and they owned a nice house in Newtown, and they sold it for about $300,000. Well, that house would easily be worth about $600,000 today. And I know this, these folks kicked themselves because we had this discussion 10 years ago, when they wanted to move, and they considered renting out that existing place and buying their new place. And I know that they would love to have that place and not only still own it, maybe be able to come back to it or leave it to their children, or, many, many options there, but certainly that ongoing revenue from it, because that started at about $2,000 a month, and they could easily get $3,000 a month today. So you could rent existing, buy, or rent new. You could also, we talked about sell and renting new, right? Yep. So there are different options there. You could be as creative as Airbnb, or you can just do a traditional rental. Now let's talk about funding. We talked, of course, about traditional mortgage. And that's very simple, right? You put a certain amount down. Let's just say that your new house is $500,000, and you have $300,000 in gains from your old house. And if you have a mortgage on your own old house and can walk away with $300,000, well, traditionally you put $300,000 down and have a $200,000 mortgage, and you pay that off over time. You, of course, and you don't have any capital gains there, you're going to have to pay that mortgage balance as you go. So you need some source of revenue or income to pay that mortgage. So of course that has to be part of your plan. You could, of course, sell investments to fund. So if you get $300,000 for your home, right? 300, as an example, $300 sale of home. That's what you net out. And then your new home is $500,000, so you need another $200,000. You can, if you have it, you can sell investments to cover that. and then you don't have a mortgage, and that might be best for you. Then you could also come up with a way to sell those investments over time to pay off that mortgage, because what you have to be careful about is capital gains, right? So many people have long-term capital gains. They've had these investments for a while, and that $200,000 could have a lot of embedded gains that you're going to have to pay tax on. So you got to be careful with capital gains. And then if you're selling these investments, you also give up opportunity, right? So your investments can't grow anymore. So one of the things you just, as an alternative, what you might want to consider, I'm just going to do this in green, is you can leverage, and I have that on the option, leverage existing taxable, just the taxable investments, existing investments. So you can take out a line of credit. So you take out a line of credit on your investments. You can, depending on how they're structured, typically 50 to 75% of your investments are available. If you have a lot in bonds, like government security bonds, then you can go higher than that, up to 90%. But basically, you take a loan on your investments, you have a line of credit. Interest rates are very low today. You can also do a loan, a fixed loan on your investments. I know we're going a little over, so it's going to take us to 11 today, and that's okay. We started this as an hour, and then I cut it down to 45 minutes, but I think we're going to have to start going back to an hour. You can do a fixed loan over a period of times, and the benefits of this are you don't have to liquidate, right? So you don't have capital gains. You also continue to potentially appreciate with those investments. So your $200,000 could continue to grow. Now it could go down. So you got to be careful about that, because there are call provisions on that. So typically, if the market drops, your investments drop to a certain level, the bank that lends you the money for this line of credit or a fixed loan might say, we need additional money to put into this investment account to keep the loan good. So you've got to be aware of that. But this is a great tool to use. Leverage existing investments using a line of credit or a fixed loan, so you don't have to pay capital gains. You don't have to give up that opportunity cost. Now, also, when you use leverage, if you're able to, you got $200,000. Let's say you have $400,000 in investments. You're able to take $200,000 out of that using a loan or a line of credit. What's the tax on that $200,000? We know if you liquidated it, you would have to pay capital gains. What's the tax on that? Well, the tax, because it's a loan, equals 0%. So you don't pay tax on that. So that's a nice tax advantage way to do that. You can also draw from your cash value life insurance or life insurance retirement plan. So if you have a cash value life insurance or life insurance retirement plan in place, and you've seen me draw this before, here's your LIRP or cash value life insurance. As this money grows for you in here, you're funding this. As this money grows, let's just say you have $300,000 worth of cash value. Well, you could draw, $150,000 out of here, or maybe even $200,000 out of here to pay for your home. You could take a portion, maybe $20,000 a year, to help pay rent. And don't forget the really big advantage of these properly structured cash value life insurance and life insurance retirement plans. Anything you take out of here is also 0% tax. So that may be a much better strategy than liquidating those investments, paying capital gains, or distributions from an IRA, because that was one of the options, because again, 0 tax. Now let's talk about IRAs. So a traditional IRA, we know that any distribution is going to be the tax. You're going to have to pay tax, right? And in the future, we don't know what that tax rate is going to be. So it's probably not a great plan to think about, well, I'm going to use distributions from my traditional IRA to fund my housing, because at some point, the dollar value of your traditional IRA gets smaller and smaller. If those distributions get smaller and smaller because of the tax. Now, if you want to have that as a plan for your Roth IRA, well, we know you 0% tax. So if you want to earmark distributions from your Roth IRA to fund your housing, that's probably a better plan. But you have to get your money from traditional IRA to Roth IRA. So that's part of the strategy, of course. All right, I've got a lot of questions coming, so let me just pause here. All right, Walter. Let me come back to these questions because I'm close on time, and these are complex, good questions. I'm getting close on time, and I want to finish this. The other thing that you could use is a home equity line of credit or a home equity loan. Now, you obviously can't use a home equity line of credit if you are doing the traditional buy-sell. That won't work, right? Because you're selling your home and you're buying a new one. Now, you could do that in the interim. If you're planning on using a traditional buy-sell and you want to use a home equity line of credit, you would establish the home equity line of credit or home equity loan, but probably a home equity line of credit would be better, on the house that you're willing to sell or you're going to sell. And use that money at least for a down payment or really mostly for a down payment on the house that you're looking to buy. Again, that eliminates the need to liquidate securities, pay tax, lose the opportunity, distributions from the IRAs that you may not want to do at that point. It gives you more flexibility. The problem with that, of course, is once you sell this home, you've got to satisfy the home equity line of credit and the home equity loan. But here's where it can be beneficial. Home equity line of credit, home equity loan. What if you are renting and buying, right? So this is the existing, this is new, or renting and renting. Well, could you then have a home equity line of credit or a home equity loan on the existing? Of course you could. So you could use the leverage of your existing home, right? Because to buy the new home equity line of credit or home equity loan, and have a more flexible type of mortgage structure, and the rents that you're receiving, remember the $3,000 to $4,000 a month, would help pay, or maybe pay plus more, the home equity line of credit or home equity loan. So you'll see here that there are a lot of different options for funding of your housing situation in retirement. And I would say that this is certainly in the top three with folks most of the time. You know, where am I going to live? How am I going to fund this? I've got this property. It's all very big. There's all very big unknowns. You know, how much am I going to get for it? What's that going to be? Where am I going to live? How am I going to fund it? So you can see that there's a lot of exciting ways to handle that. And it's not all traditional, right? It's not all just, I need a mortgage. Oh, I didn't talk about reverse mortgage. Don Graves would not be happy with me. Then you have a reverse mortgage. Well, a reverse mortgage used to be, I always thought of it as, well, if people are really back against the wall and they need to dip into the equity of their home to live off of, that's what a reverse mortgage is for. Well, I learned some time ago that really isn't the best use of a reverse mortgage. It's fine if that's what you're using it for, but you could, if you're buying a home for $500,000, you could fund that entire $500,000 or a large portion of it using a reverse mortgage. So you had no mortgage at all. Now, the cons are that the interest rates are usually higher, right? They're higher interest rates than the traditional mortgage, but today they're pretty darn low. Still, you could also have a reverse mortgage line of credit on your home, right? The home that you're in today. And what happens with that is that line of credit increases every single year. So if it starts at $500,000, let's just say, it could easily be $700,000 within, I guess it would take about 8 or 9 years. But then you have a lot of flexibility for many things. You could use that for, purchase of another home. You could use that for long-term care expenses, home purchase, a lot of different things that you can do. And of course, those distributions are also tax-free, zero tax. So reverse mortgage, don't be afraid of them. You have to do your research about it. You have to learn the details. In fact, you have to go to a class if you're going to use them. So it can be a good option for you. So there are a lot of good options. You have to work through these things. You have to review it on a regular basis. You've got to, kind of exhaust all the opportunities before you commit yourself to something, is what I like to always say. So I hope that was helpful. So we reviewed the market activity. We went over the slot report, talked about some analysts, and then we honed in on this a little bit, right? There's still a lot of work to do. We honed in on this purchase, sell, what your choices are for housing and retirement. So again, if you're watching this on a recording, you can use the link to schedule time with me. If you're live, you're going to see a calendar pop up that's going to show that you have an opportunity to schedule time. Nothing in December, but I do have some time in January, a little later in January. But I hope this was helpful. Let me just see if we can answer some questions before we sign off. There are a lot. And Michael, I saw you raise your hand, but I'm not, I don't know if you have a question or not. Okay, I'll take a couple minutes for questions. So Walter asks, hello, Walter. Are Roth withdrawals excluded from income thresholds of capital gains taxation rates? And then you have a follow-up. To my surprise, Roth withdrawals are not excluded from New Jersey property tax-free income income limits. So federal tax and state tax are different. Obviously, state taxes are different in each state, but Roth withdrawals are not taxable, so they're not going to count as modified adjusted gross income for income thresholds of capital gains rates. Michael asks, do line of credit interest rates compare favorably to traditional mortgage interest rates? That's a good question for a mortgage advisor or a mortgage broker. Michael, what I found is that the rates are generally lower for lines of credit. When you get in, but they may be variable. So you want to be careful in a low interest rate environment like we're in with variable rates. You've got to kind of figure out your comfort of, how much you can afford if interest rates go up. And a loan in today's environment might be better for you. So the difference between a line of credit and a loan, again, is a line of credit, you get access to the funds, you can use them at any time. A loan, they say, okay, we're going to lend you this money, comes out, you're paying interest from day one when you receive the money. A line of credit, you don't pay interest until you actually pull the funds, which could be never, right? I typically recommend that everybody with a home has at least a line of credit, so you have immediate funds available if you need them for some reason. You can typically, and most of the time, transition those to a fixed loan if you need to at some point, if the variable rates get uncomfortable for you. Or if you know what money you need and what the use of that money is, you can just set up that loan right now. I am just not a fan of taking money out of, for this example, from your house or your securities as a loan and setting it aside, because the interest never balances out. You're paying more interest than you're typically getting. You don't want to invest these funds because there's too much risk of loss. And in fact, if you're using a line of credit or a loan from your investment accounts, you cannot invest those funds. It's one of the rules. So I hope that was helpful. Michael, I can't, and chat's supposed to be disabled, but if you want to put it in, I'm sorry, I'd love to be able to chat with you here. I don't know why that's able, but if you want to send me an email or put it in a question, that'd be great. Folks, I appreciate your time. I know even by normal standards, we went over, it's 11:05, but this is a big topic for a lot of people. I hope it was enjoyable. I hope to see you soon. And if you have any questions beyond what we talked about today, send me an email and we'll talk about it. Thanks very much. Take care.